Tanner's been thinking about it for months. Maybe it's time to stop renting. Maybe it's time to actually buy a place. How hard could it be? Turns out very, because the housing market ghost has been waiting for Tanner for a long time.
Man, that was a wild dream.
Tanner does the smart thing. Before he looks at a single house, he visits a lender.
Before you go house shopping, you need to get pre-qualified. Without it, no serious seller will even look at your offer.
And the first thing the lender tells him stops him cold. Pre-qualification. Tanner had never heard the term, but it's the most important step a first-time buyer can take, and the ghost absolutely hates it. Pre-qualification is the process where a lender reviews your financial picture and tells you approximately how much house you can afford. It's not a guarantee, that comes later with full pre-approval, but it's your starting line. The lender will look at 4 things: your income, how much you make, and how stable it is. Your debt. Credit cards, car payments, student loans, your credit score, the higher the better. And your assets, savings, investments, what you can bring to the table for a down payment. According to the National Association of Realtors, the median credit score for recent home buyers is 768. That's not a requirement, but it tells you where the competition is. The ghost loves that number. It scares a lot of people away before they even try. Once the lender runs Tanner's numbers, the conversation turns to affordability. And this is where the ghost really goes to work. Mortgage rates have been significantly higher than the historic lows buyers enjoyed during the pandemic. At 7%, a $350,000 home with 10% down carries a monthly payment of roughly $2,300. This does not include taxes and insurance. A few years ago at 3%, that same home was closer to $1,400 a month. The National Association of Realtors Housing Affordability Index has fallen sharply, meaning the average family now qualifies for significantly less home than they did just 5 years ago. The ghost didn't cause interest rates to rise, but it sure likes scaring people with them. The general rule lenders use is the 28-36 rule. Your housing costs should not exceed 28% of your gross monthly income, and your total debt, including housing, should not exceed 36%. Know those numbers before you walk into any lender's office. Even if Tanner gets pre-qualified, he faces another ghost-fueled nightmare. There aren't enough homes to buy. The National Association of Realtors estimates the United States is short approximately 4 million homes. Builders slowed construction after the 2008 financial crisis and never fully recovered. The result, more buyers competing for fewer homes, driving prices higher and higher. In desirable markets, homes routinely receive multiple offers within 48 hours of listing. Cash buyers and investors often outbid first-time buyers who need financing. It's not a fair fight, and the ghost knows it. And then there's the voice in Tanner's head, the one that sounds a lot like the ghost. Economic uncertainty is one of the ghost's most powerful weapons. Many first-time buyers are sitting on the sidelines waiting for rates to drop, waiting for prices to fall, waiting for the perfect moment. But here's the truth, the ghost doesn't want you to hear. Timing the housing market is nearly impossible. Even professional economists get it wrong. So how does anyone actually save enough to buy a home in this market? Here are 5 tips that work. And the ghost desperately hopes you never learn. Tip 1. Open a dedicated high-yield savings account. A high-yield savings account earns 4 to 5% interest right now. Your money grows while you save. Automate a transfer every payday. Treat it like a bill you can't skip. Tip 2. Attack your debt first. Your debt-to-income ratio directly affects what mortgage you qualify for. Paying down credit cards and loans before applying doesn't just feel good, it mathematically increases your buying power. Tip 3. Boost your credit score intentionally. Pay every bill on time. Keep credit card balances below 30% of your limit. Don't open new credit accounts in the months before applying. Going from a 680 to a 740 credit score can save you tens of thousands of dollars over a 30-year mortgage. Tip 4. Research down payment assistance programs. Most states offer first-time buyer grants and low-interest loan programs that can cover part or all of your down payment. The Ghost counts on you not knowing these exist. HUD lists every program available in your state at HUD.gov. Tip 5. Consider house hacking. Buy a duplex or small multi-unit property, live in one unit, and rent out the others. Your tenants help pay your mortgage while you build equity. It's not glamorous, but it's one of the fastest wealth-building strategies available to first-time buyers.
Are there any first-time buyer incentives?
Yes, we can explore several options for you.
The lender has one more surprise for Tanner. Incentives that exist right now in today's market, specifically designed to help first-time buyers get through the Ghost's defenses. FHA loans, backed by the Federal Housing Administration. These allow down payments as low as 3.5% with a credit score of 580 or higher. Lower bar to entry, government-backed security for the lender. Conventional 97 loans, Fannie Mae and Freddie Mac programs that allow just 3% down for first-time buyers with good credit. USDA loans. If you're open to buying in eligible rural or suburban areas, USDA loans offer zero down payment options. 0. The Ghost hates rural markets. VA loans for veterans and active military. VA loans offer zero down, no private mortgage insurance, and competitive rates. One of the best financial benefits available to those who serve. State and local programs. Many cities and states offer closing cost assistance, reduced rate mortgages, and forgivable loans for first-time buyers. Check your state housing finance agency. These programs are real, funded, and underused.
Inner, you may hear about something called an adjustable rate mortgage, or an ARM. I want you to understand exactly what it is and whether it's right for you.
Before Tanner leaves, the lender covers one more topic. One the Ghost is hoping Tanner gets wrong. An ARM starts with a fixed interest rate for an initial period, typically 5, 7, or 10 years. After that, the rate adjusts periodically based on market conditions, which can be super scary. It can go up, it can go down. You don't control it. The appeal of an ARM is a lower initial rate. In a high-rate environment, a 5/1 ARM might offer a rate at a full percentage point lower than a 30-year fixed, saving hundreds per month in the early years. Who should consider an ARM? Someone certain they will sell or refinance before the fixed period ends. A buyer definitely planning to move within 5 to 7 years. Or someone with sophisticated financial knowledge who can absorb payment increases. Who should not use an ARM? First-time buyers planning to stay long-term. Anyone on a tight budget who cannot absorb a payment increase. And anyone not completely comfortable with financial uncertainty. An ARM is not for everyone. Just wanted to throw it in here, Tanner. The 30-year fixed mortgage is one of the most powerful financial instruments ever created for everyday people. Predictability is not boring. It is protection. Before we get to Tanner's victory, let's settle one question the Ghost uses to confuse new buyers. Is renting really throwing money away? Every rent payment you make builds your landlord's wealth, not yours. It keeps a roof over your head, and that has value. But it builds zero equity, zero ownership, zero net worth from that transaction. A homeowner making the same monthly payment is doing something fundamentally different. Part of every mortgage payment reduces the loan principal. That's equity. Home values historically appreciate over time, that's more equity. And when you sell, that equity comes back to you. The National Association of Realtors data shows the median homeowner has a net worth approximately 40 times greater than the median renter. 40 times. That gap is not an accident. It is the compounding result of ownership versus paying someone else's mortgage. The housing market ghost is real. The barriers are real. The rates are real. The competition is real. But so is your pre-qualification letter. So are the assistance programs. So is the 30-year fixed rate that nobody can touch once it's locked. Knowledge doesn't just prepare you for the housing market. Knowledge is what makes the ghost disappear. Thank you for watching. Please like and subscribe and let us know in the comments what financial monster you want Tanner to face next.